All right. Thank you, everyone, for your responses. And we can now begin. Good morning and hello and welcome to one and all. My name is Sharanya Maheshwari.
And my name is Dia Garg, and we are the founders of Know Your Money.
Know Your Money is an organization which aims to spread financial literacy amongst the youth of India. We realize that there is a current gap in the education system with regards to financial literacy, and we at Know Your Money seek to bridge this gap. Today's session will be about the stock market. Now, there's a stigma around the stock market that, oh, this is a bit difficult, or oh, this is a very demanding thing, but we are here to break this stigma. So feel free to use the chat box option to send in any questions. If you have any doubts, we'll be happy to answer them. We do request you to refrain from unmuting during the session as it will interrupt the flow of things. And we hope that some of you can switch on your cameras as well, and let's try to make this an interactive session. And so without further ado, let's get it right into the session.
So, what is financial literacy exactly? And this topic may seem a bit daunting because there are so many things that fall under it, but it can broadly be classified under these 7 pillars. So, the first pillar of financial literacy is earning. And earning is basically when you do some work, and in return for the work you do, you receive some form of payment. Then we come to spending. And spending, I mean, a lot of you would have, know about these terms. So spending is essentially when you spend your money to buy a good or a service. And a good is like a physical commodity such as books, clothing, or a car. And a service is something that is non-physical. So just like the word service itself suggests, it's a service that someone is providing to you. For example, it could be education, medical treatments, or like something like a haircut. The next pillar is saving. So saving, as you know, is when you put your money aside to spend in the future. And you could be saving your money to spend for, to save for rainy days in case there's some financial emergency. Or you could save your money to, have enough money when you retire. Since when you retire, you don't have that steady flow of income and an earning source. So the money that you save will help you to buy the things you need when you retire. Another reason people may save could be to buy a big financial purchase that might be very expensive, like a house or a car. The next thing is budgeting. So imagine that you spend a lot of your money on the things you want to buy and the things you feel like you need, but in reality, you realize that you don't have enough money to spend on the things that you actually need. That leads to a lot of problems, right? But this can actually be countered if you budget your money, which is creating a spending plan for your expenditures so you can prioritize what you really truly need. Then we come to borrowing. And then we come to borrowing. So borrowing is when you take or borrow money from a financial institution like a bank, or you can borrow from, let's say, even relatives or a friend with the promise that you're returning back the money and paying an extra sum of money known as interest. People may take out a loan to, fund a big expense like a house and pay this money sometime in the future. Then there's protecting. So protecting is another very important pillar of financial literacy, as these days, in the digital age, there are so many scams that we hear about. I'm sure a lot of you would have gotten these messages or calls, scam calls asking you to enter bank details and all of that. So it's very important to know how to protect your money. And lastly, we come to the topic of today's session, which is investing. So what is investing? Investing is the process of buying assets with the expectation that you'll get a positive return in the future. And an asset is a resource that you can buy. It can be, like an asset, for example, something in real estate, or an asset like a part of a company. And you expect this to have a higher return in the future. So you expect that it'll give you a positive benefit in the future. Okay. So now you may ask, why should I invest? Is there any advantage of investing? And the first biggest advantage of investing is that it helps to outrun inflation. And inflation is basically when, as over time and as time goes, the value of money declines. So for example, let's say that in the year 2020, there are two people, X and Y. So the price of a plot of land is 35 lakhs, and X has 40 lakhs and Y has 40 lakhs. But they both decide that, right now it's not a good option to, buy the land, and they want to, keep that money with them at the moment. X chooses to just store that money aside and keep it on the side, whereas Y chooses that 40 lakhs they'll invest it. So 20 years later, in the year 2040, the price of the plot of land appreciates. So it increases to 55 lakhs from 35 lakhs. And this price of the land is the same for X and Y. But the cash at hand for X is 40 lakhs since X didn't invest this money before. And they still have the same amount of money as they did in 2020. But Y had invested this money and it had increased by 20 lakhs to 60 lakhs. So as you could see that Y was able to outrun inflation and have enough money to buy the plot of land, while now at this moment, X has lesser money, so they can't buy the plot of land. So this is a very important thing that investing allows you to do, which is outrun inflation. The second positive advantage of investing is that it helps you reach your financial goals, as it helps you build your wealth. And the third one, of course, is that it helps you save for retirement and often early retirement as well. And these two concepts of saving and investing are often misinterpreted, and people feel like they can interchange the two, but that's not the case, because saving is when you set aside a part of your income that you will spend in a future date, while investing is when you put the saving into financial instruments or products such as shares, bonds, units, property, and even term deposits. And savings may not help you outrun inflation, as generally about this, the interest rate you get on savings or putting your money in the bank would be around 3%, but the potential to earn higher returns is very high in investing. Although risk and returns goes hand in hand, and you could have a potential to risk your money and lose your money in investing, it's still a better option to think wisely, and if you invest wisely you can have a potential to earn much higher returns.
All right, so we have collated the four most commonly used investment options in India. But before that, I would just like to emphasize that risk and return go hand in hand. So the higher the risk you take, the more the returns you will probably be getting. So let's see the first investment option in India. The first one is real estate. Real estate investment involves transacting commercial and non-commercial land. For example, sites, apartments, commercial buildings, land, etc. And there are two main sources of income from real estate investments. The first one would be your rental income, and the second one would be capital appreciation. Capital appreciation means after you buy that land, keep it for a period of time, and when you sell that land, the profit you gain upon selling that land, that will also be a form of your income. The second investment option in India is your fixed income instrument. These are instruments on which investors receive regular payments for a period of time, and thus it is comparatively a less risky investment, but your returns are comparatively lower to real estate. Now, this includes your FDs by the bank, the bonds issued by government, and other corporates. Then we go on to the third investment option, which is your commodities. Now, at home, you may have heard your parents purchasing gold and silver. What are these? What is this? This is all commodities. So, marketable commodities are assets that retain their value regardless of how much time passes. So, which is why it is a very, very safe investment. Investing in gold, investing in silver is considered to be very safe. And investments in these are often appreciating in value over time. Then we get on to the topic of the day, that is equities. Equities, which are sometimes also called stocks, are portion of a company that the public can purchase to become shareholders. Now, investors can use equity to use equities to earn money in the form of dividends, which we'll be covering later in the session. But do remember that investing in equities does involve some amount of risk, and do remember to always research before investing in equities. So let's move to the topic of the day, which is the stock market.
Okay, so now let's watch a video on how the stock market scene used to look like in Bombay back in 1995. And as you can see in this video, you'll see that people are, all around the place and exchanging stocks. And so let's see the video. Yeah. Is it audible?
Yeah, I don't think you're sharing the audio.
The audio is not, it's not audible.
No.
Okay, give me a second. think it should be fine now.
Welcome to Bombay, a trading post for centuries, gateway to India and one of the jewels of the British Raj. No stranger to commerce and trade, it's a city that has wholeheartedly embraced the new capitalism. A city where even the billboards urge punters to invest. Nowhere is the frenzied energy of Bombay business shown more than here at the stock exchange. Brokers pray for luck just to survive as they enter the human maelstrom of the trading floor, now the busiest in the world. This is share trading as it used to be, where brokers are elevated to the status of cult heroes and regulation spurned.
Okay, so as you can see in that video, the scene back 27 years ago in Mumbai was highly chaotic in the stock market, and there wasn't really a proper regulation system, and people were just all over the place, doing that stock exchange system. But nowadays, all of these transactions, everything has become digital. So let's look at one second. Let's look at what a stock is.
All right. So a stock is a security that represents ownership of a fraction of a company. So, for example, if a company is likened to a pizza and you take one slice of that pizza, this means that you are part owner of that company and your share is worth that one slice. Units of stock are called shares, and this is a percentage ownership in a company, as I've already stated. Now, as the value of a company increases, so does the stock price, and we'll be later seeing what are the factors that may be affecting the valuation of a company, the external factors, internal factors, etc. So there are two main types of shares. Number one being equity shares. These are the types of shares which are usually traded in the stock market. And these equity shares have special voting rights through which one can vote on mergers, board decisions, and other financial decisions of a company. But do note that you must be having a qualified number of shares or a sizable chunk to be able to exercise these voting rights. If this regulation was not set in place, since these shares are issued out to the public, anyone and everyone who has just even maybe 0.001% of these shares would be able to make such decisions, and this would be a management disaster. Now, do note that the return on equity shares is not fixed and may depend on the profitability of the company. The second type of shares, which are most commonly issued, are preferred shares. Now, these shares don't have any voting rights, but they do have advantages in terms of return. And on preferred shares, there is a fixed rate of return over the year, and obviously the risk is lesser, so the return is lesser compared to an equity share. Now, why do they call it a preferred share? Because preferred shareholders are the first ones to get a return on their investment. After the dividend for the preferred shareholders is fulfilled, then the company goes on to giving the remaining amount of profit to the equity shareholders. Now, who is a shareholder? A shareholder is any person, company, or institution that owns at least one share in a company, and it is not defined by the amount of percentage you own. Even if I own 0.00001% of the company, I will still be called a shareholder. So that was it about stocks. Now let's move on to what is a dividend. So, like in real estate, you would earn rent. In stock market, you earn what is called dividend. Dividends are payments from a shareholder receives from the company's earnings, and they are paid on a regular basis. This may be annually, and more commonly, it is on a quarterly basis. And they are one of the ways investors earn a return from investing in stocks. Do note that not all stocks may be paying dividends. So how does dividend work? A dividend is paid per share stock. So for example, if you own 30 shares in a company and the company pays $2 per share in annual cash dividends, you will be receiving $60 per year. So that will be a dividend on top of your base price, which you'll receive. And some people may even call it as profit if you sell the share after the dividend has been received. Now, why do people invest in dividend stocks? Because they are a source of income. So, people who are new to investing can put the dividends to work immediately in their portfolios by reinvesting them. Dividend stocks are highly popular amongst the youngsters nowadays because they provide an alternate source of income other than their work, their employment, etc. So, I have mentioned that not all stocks pay dividends, and let's see why only some companies pay dividends. Some companies would be paying dividends because they have good financial health. So, for example, they're doing good in profits, doing good in revenues, and they're able to pay their shareholders that extra amount of money. Or it can also be to attract investors and drive their share price up. So, how would this happen? Now, if a share is doing really well, providing free annual and regular dividends, then the public may see that this is a good stock, and they will be attracted to that stock, and this would mean that the demand for that stock would go up, and thus the share price would also go up. Now, why do some companies not pay dividends? The first reason obviously being that they're suffering losses, their revenues are not on point, they're facing some issues then in their management, or whatever could be the reason for the value of the company going down, and thus them not being able to pay dividends. But a second reason, and this is especially in the case of young companies, is because they want to reinvest their capital to fuel growth. So what this means is that they take the money that their shares have received from the public. They take that capital and they put it into, let's say, research and development, let's say innovation, product diversification, and many other things, so as to sustain their brand. And then maybe after 2 or 3 years, after they've become a bigger brand, they have they have more products, etc. And when they're having better revenues, maybe then they'll start giving out dividends. So this was all about how dividends are, what which shares get dividend, which shares don't get dividend, and why people may be investing in dividend stocks. So the next thing we have is about the market.
Okay, so what is a market? And I'm sure a lot of you would have heard about different types of markets. For example, let's say the vegetable market, or the market for clothes, the clothing market, or maybe a market for electronics. And a market is basically a place that links sellers with buyers. So as you could see, even in a market like a vegetable market, it's linking the vegetable seller with the buyers who want to buy the vegetables. So now let's look at what a stock market is. And a stock market, like it says, it's a market for stocks. So it's a place where the shares of publicly listed companies are traded. And it refers to the venues of buying, selling, and insurance of shares of publicly held companies. And in a stock market, it links the buyers, so the people who want to buy stocks or the investors, with the people or the companies who want to sell these stocks. So, I mean, have any of you heard of any stock market in the world? And just put it in the chat box if any of you know a stock market. Yes, Arav, that's right. Nasdaq is one of the biggest stock markets in the world, and it's in the US. Yeah, another one is BSE. So, BSE is Bombay Stock Exchange. Um, then yeah, NSE is also one of the biggest stock markets in India. It's the National Stock Exchange. Yeah, so these are all right answers, and let's look at which are the biggest ones in the world. So the largest stock markets in the world, the first one being NYSE, which is New York Stock Exchange, and that's in the US. And then, like one of you said that NASDAQ is also another stock exchange. And in India, the largest stock markets in India are Bombay Stock Exchange, National Stock Exchange of India, Calcutta Stock Exchange, and India International Exchange. So in India itself, there are many different stock markets. So there are even state-specific stock markets, but these are the biggest ones. And Bombay Stock Exchange was actually the first stock market in Asia. But these days, most of the exchanges happen in the NSE. Okay, and in a stock market or in any market for that matter, there must be some sort of regulator or some body that makes sure that all of the transactions happening are happening in a proper manner and there are no fraudulent practices. So in India, the stock market regulator is called the Securities and Exchange Board of India, which is also referred to as SEBI. In the US, you might have heard of the SEC, which is the Securities and Exchange Commission, but the regulator in India is SEBI. And there are three main roles of the stock market regulator. The first one being investor protection. So this is one of the most important objectives of setting up SEBI, and it involves protecting the interests of investors by providing guidelines and ensuring that the investments done are all safe. The second role is the smooth functioning of the market. So, the role of SEBI is to prevent fraudulent practices and malpractices, which are related to trading and the regulation of the activities of the stock exchange. Because some people can take advantage of investors, and this is a fraudulent practice that should not happen, which is why the SEBI has been set up to prevent this. And the third one is fair business practice, and this is to develop a code of conduct for the financial intermediaries. Okay,
Now that
so
we have seen the different stock markets and the different um, stock market regulations, let's see who all can participate in the stock market. So we've divided them into five main categories. Although this is not an exhaustive list, but this is the majority participants in the Indian stock markets. Number one, we have are the domestic retail participants. These are people like you and me transacting in the markets. Then we have NRIs and OCIs. Does anyone know the full form of NRIs and OCIs? And please feel free to put them in the chat box. That's right, NRI is non-resident Indian. And what about OCIs? Overseas citizens of India. Great job, guys. So these are people of Indian origin but based outside India. Then we have domestic institutions like your pension fund, insurance companies, mutual funds, etc. These are large corporate entities based in India, and a classic example would be LIC India. Does anyone know what's the full form of LIC? If you could just put that in the chat box. That's correct. LIC is life insurance. This has a lot. This deals in a lot of insurance plan options, and many of us may also be having an LIC plan. Number four, we have foreign institutional investors, which are non-Indian corporate entities like foreign asset management companies, hedge fund companies, etc. And on number five, we have domestic asset management companies, which a typical participant would be mutual fund companies like SBI Mutual Fund or HDFC, AMZ, etc. So these are the big categories of stock market participants, and while there may be more, these are the ones which are usually involved or mostly involved in the stock market in the Indian context.
Okay, so now this is the next segment of the presentation, which is financial intermediaries. And a financial intermediary or an intermediary is an entity that acts as a middleman between two people. So it can be in the stock market, it's between an investor and the market, or it could be between a company and the market. For today's session, we'll be focusing on the financial intermediaries between the investor and the market. Specifically, we'll be focusing on stockbrokers and the demat account.
Okay, so the first and foremost paramount intermediary is the stockbroker. But when we were searching about what stockbrokers are and their functions, etc., we were just wondering why would they be called a broker? It's such a weird thing that a stock they call brokers. So we went on Google and we did a search. So we came up with this is what Google told us, that the word broker derives from Old French procure. Apologies for my poor French, meaning a small trader. So that is how the word stockbroker uh, came into use. And yes, so let's go forward. Now, what is a stockbroker? A stockbroker is basically a channel between the investor and the investment. So suppose you want to buy stocks, right? So you can ask a stockbroker to suggest some stocks, and with their suggestions, you can purchase these stocks. So to be able to trade on the stock market, you need to open a stock a trading account with a broker who meets your requirement. So this can be with regards to your capital requirements, right? So some of us may want to be investing more, some of us maybe want to invest in less. And to be able to invest in the stock market, you need a trading account. So that's the first thing you need. A trading account is one through which you buy or sell stocks, and this is managed by your stockbroker. So after you have a trading account, you have two choices. Either you can call, if you want to buy a stock, you have two choices. Number one, you could either call the stockbroker and say, okay, I want XYZ stock and please buy it on my behalf. So the stockbroker will buy it on your behalf and it'll be in your transacted through your own trading account. The second option is that you can actually buy and sell it yourself as well. And what the stockbroker does is they provide access to the trading terminals provided with software support. And that is how a stockbroker is very helpful in both cases. Now, the usual trend is since we all have the working lives, college lives, etc., usually what people do is they'll just ask their stockbroker to trade and invest on behalf of them. So another basic services provided by a broker is they issue contract notes for transaction. Now, a contract note is a written confirmation detailing the transactions you have carried out during the day. For example, at the end of the day, you'd get XYZ has purchased, let's say, 100 shares of Infosys for X amount of money. So this is basically a summary you get at the end of the day, and to note how many shares you have, what you have, and how your money, where your money is going, how much of your money is going, etc. And also, your trading, do know that your trading account and your bank account is different, right? Your bank account is the account where you receive your income from employment, you receive your rent, etc. And you can't use your bank account to trade. You need to be able to transfer some of these funds into your trading account, and those funds only are used in your transactions in the stock market. So what a broker does is also facilitate the fund transfer from your bank account to your trading account. Obviously, because the stockbroker is a middleman, they will be charging a fees, which is called the brokerage fees or just brokerage. And these rates may vary from broker to broker, but it is up to you to be able to strike the best deal. Best deal in the sense that the right amount of services for the right amount of money. Now that was about stockbroker. Let's go on to a demat account. Now, in terms of a demat account, before we start about the demat account, let me ask you a very simple question. If you buy a plot of land, what according to you can be a thing that you use to claim that the land belongs to you? So feel free to put in your answers in the chat box. If I could just repeat, my question is, if you buy a plot of land, what according to you can be a thing you use to claim that the land belongs to you? That's right, registered land documents, property papers, etc. So similarly, in the case of shares, to claim that the shares belong to you, there is a share certificate issued. Now, on the right side of the screen, you can see a physical share certificate, and this is how it used to be issued before 1996. Before 1996, all these share certificates were physical, they were tiresome to handle, cumbersome to manage, etc. But after 1996, there was a digitalization of the share certificates as well. They are now they can be now formed in an they are now found in an electronic form, which are obviously easier to maintain, easier to handle, and can be accessed from any part of the world. Next. So, what is a demat account then? A demat account is like a storage or a safe house or an electronic vault which contains all your certificates. Right. So when you buy shares, these shares come into your demat account. When you sell these shares, they go from your demat account. So a demat account is an account for your shares. Next. Now, just like how stock in a trading account, a stockbroker help you manage the trading account. For a demat account, a depository is the financial intermediary that helps you manage the demat account. So to open a demat account, you need an agent known as the depository participant, which helps you set up these accounts. Now in India, there are two main depositories, and these are the only depositories found in India. They are the NSDL and CDSL. NSDL is National Securities Depository Limited, and CDSL is Central Depository Services Limited. So, to come to the end of financial intermediaries, we need to know that to open a to start trading in the stock exchange, we need three main accounts. Number one being the bank account, where you get your money. So all your money is stored in your bank account from any investment, from any source. All your sources of income will come towards your bank account only. Then we need a trading account. Now, what is a trading account? A trading account, as we have discussed already, is the money that you take from your bank account. You'll be putting that into your trading account, and that is the money you'll be using to transact in the stock exchange. Now, after you transact in the stock exchange, you'll be buying some shares, you'll be selling some shares, and this would come from your demat account. All these transactions from your demat account, the buying and selling of shares, the profits or the losses you incur will be going to the trading account, and from that it will be going to the bank account, and from the bank account is the place where you can use it to buy the daily things, etc. So these are the three main financial intermediary in the stock market. And what we have analyzed right now is from the general public perspective. We have not gone into the company specifics right now, because that is at another level of complications. But right now, from a general public perspective, the two main stock market intermediaries will be your broker and your demat account. And the three main accounts you would require is a bank account, trading account, and a demat account. With that, we'll be moving on to the price, which is our next segment of today's session. Now, have you ever wondered, why do we say that the share market is going up or the share market is going down? Or why do the prices of some shares go up, or why do the prices of some shares go down? So we'll be covering all this in this segment of today's session.
Okay, so like Sharanya said, in the share market and the stocks, the price keeps fluctuating. So sometimes you hear that a stock price is going up, or sometimes you hear that the stock price is going down. And essentially, in a stock, it's divided into three things, which is a bid, an ask, and the current price. So the bid is the highest price that a buyer is willing to pay to buy the stock. For example, take the example of an auction. There's someone who is willing to pay the highest amount. Just like that, there's in a stock, there's a bid, which is the person who's willing to pay the highest amount. And then there's an ask. And ask is the lowest amount that the company is willing to sell the stock for. So both the bid and the ask, they are generally around the current price, which is the current share price or the current price of the stock. And the difference between the bid and the ask is known as the spread. And these are just a few financial terms for you, so that when you're reading about the stock market, you can understand what they mean. And just like any other market, the stock market functions on the similar principles of the demand and supply. And so when there's higher demand, which means that there are more number of buyers who are willing to buy the share, but there are lesser sellers, because maybe the sellers feel like the price is too low to sell the stock, so they're not really willing to sell. But the buyers feel like the price is really low, so we can buy the stock because it's such a low price. In this case, what happens is that the price rises to accommodate that excess demand, because when there are more number of buyers than sellers, that means there is more demand than supply. So the price has to rise for these two to match, for the bid to match the ask. Then the second case is when you hear that the stock market price goes down, and that occurs when the supply is greater than the demand. So in this case, there are less number of buyers, there are fewer buyers and more number of sellers, because the price must be really high. So sellers are willing to sell their stock at that price, but the buyers feel that, oh, the price is way too high to buy the stock. And in this situation, the price falls to meet that excess supply, to reduce that excess supply, and then again, the demand and supply can become equal. So now what really causes these price fluctuations? And there are a couple of factors that cause these prices to fluctuate. The first one is the internal aspects of a company. So maybe it can be how the company is doing the internal management, and if it's going on successfully, then maybe the price will go up because the company is doing well and investors have a good view of the company. The second one is the RBI policies, or the Reserve Bank of India policies. Then the third one is the value of Indian currency. So sometimes, when the value of the Indian currency increases, it is beneficial to the exporters, so the companies that export. And for these companies, their stock price goes up. But for companies who import the products and focus on more on importing, then for these companies, if they're selling their, if they're a publicly listed company and if they're selling their stock, then it's actually worse for them, since it might cause their stock price to fall. The fourth one is the political scenario. So this is another very important factor that causes fluctuation, because if people are uncertain that how the country's political scenario is going on, maybe they are worried that there could be many riots and the market isn't stable. They are really uncertain of the future, so they choose not to invest their money because they don't really want to take that risk. And this is the case when this causes lesser number of buyers to be there, so the stock price falls. The fifth one is a natural disaster, and natural disaster can really be any type of natural disaster, and we ourselves have gone through a natural disaster, which is the COVID-19 pandemic, which is a medical disaster. So we in the stock market itself, COVID caused a lot of disruption, and we found that the volatility of the market was 69% due to COVID-19. So as you could see, there's a lot of fluctuation in the stock market price during this time. The sixth factor, which is also very important, is a company's earnings. And if a company earns more, then people are more confident of that they'll get higher returns, so they start to invest more, which causes the price to increase. And the last factor is good or bad news. So if they receive good news, they may want to invest, and if they receive bad news, they may want to keep their money with them. Okay, so now that you have an understanding of how that works and how the stock market prices fluctuate, we'll tell you an interesting fun fact and why the markets are known as bull and bear markets.
Okay, so I think you would have heard the term bull market or bear market a lot, especially in the news or even in the latest, even in the series the big bull of the Indian markets. So let us just briefly talk about what are bull and bear markets. So let us just briefly talk about what are bull and bear markets and what do they actually mean. Emotions or attitude or sentiment of either an individual asset or an individual company stock or of the market as a whole. Now, investors use the term bearish market or bullish market to feel towards specific securities of the financial markets. Now, what does a bear market mean? A bear market refers to a decline in prices, usually for a few months, and this may again vary from company to company. Now, in contrast, a bull market is when the prices are rising.
Sharanya, your voice is
Sorry, is my
breaking a
voice
bit.
breaking?
Your voice is breaking. Can you please repeat? Yeah.
Okay, am I clear now?
Yeah, you're audible now.
All right, so I'll restart this. Okay, so what do the terms bull and bear mean? So they're usually used to describe the general feeling or sentiment of the general public towards a specific company, a specific stock, or even as the market as a whole. So investors use the term either bullish or a bearish market to describe how they feel towards, the market or the stock, etc. Now, what does a bear market mean? A bear market refers to a decline in prices, usually for a few months. So it's not just one day or 2, 3 days or something. It's over a period of time. So usually for a few months, when there's a decline in price or an overall decline in the market, that is known as a bear market. So, in contrast, what is a bull market? A bull market is when the prices are rising over a few months. So, again, this is not over 1 day, 2 days, 3 days. It's over usually a few months. Now, typically, a move of 20% of more from a recent peak or a trough triggers an official bull or a bear market. Now, fun fact, do you know why these are called bull markets or bear markets? Does anyone have any theories or any ideas to why they're called a bull market or a bear market? And why did they choose these two animals as opposed to any other animal? Very quickly, if you could just type it in the chat box. Okay, so maybe I'll reveal the answer. Right, great job, guys. So the reason why it's called a bull market or a bear market is because bulls attack by bringing their horns upward. So that's why bulls refer to an upward market trend, while bears attack by swiping their paws downwards or their claws downwards towards the ground. And that's why it's called a bear market. Now, do know that both types of market can be profitable depending on your strategy. So it's not true that only a bull market is profitable and a bear market is, you're always going to suffer losses. If you are a smart investor, if you have your strategy set in place, both markets, can be very profitable and very good for you. Okay, with that, we'll move on to what stock market indices are.
Okay, so what exactly is a stock market index? I'm sure many of you might have heard of this term, but a stock market index, which is also known as a stock index, is a statistical measure that reflects the changes taking place in the market. So, stock prices keep rising and falling, but how do you know whether a market is in the general overall sentiment in the market, or the overall how the market is doing? And this is what an index tells you, or an index tells you. So generally, when the price of the stocks increases, the index value also rises. While when the price of the stocks decrease, the index value also decreases. And this is very important for investors as they use this to identify patterns in the stock market to decide which stock to invest in. Because when they see the index, they can see if it's rising or if they can see if it's falling. And there are many different types of indexes, and you must have heard of Nifty 50, which is a group of 50 different companies that is used as a sample to show how the market is doing. And then there's Sensex, which is a group of 30 companies that is shown, and these two are the main ones in India. And a few of them in the US are like Dow Jones or Nasdaq, S&P 50, and Russell 2000. So now that you know what an index is, how do you calculate or how do you read the stock market index? And in Sensex, if you see that Sensex uses the market capitalization weighted measure, which means that weights are assigned to a company depending on its size. And if a company is of a bigger size, a higher weight is applied to it. And if it's a smaller size, a smaller weight or lower weight. And let's say there's one stock in the market. And the base value base value basically means the total value of all the market shares is 100 points. It's taken as 100 points in Sensex. So the current value of that one stock is 200. So let's say that value increases to 260. So the stock price goes up. The stock value increases to 260. That means there's a 30% increase in the price. And this is reflected in the index of Sensex, which is shown as 130. So it increases from 100 to 130. And that basically says that there's a 30% rise. So when an investor sees the index, they can say, oh, the stock price has gone up. Similarly, Nifty uses a similar method to Sensex. However, there are a few differences. So in Nifty, the base year is taken as 1995, while Sensex's base year is 1979. In Nifty, the base value is 1,000, while Sensex has a base value of 100. And Nifty is calculated on 50 active stocks, which are traded in the National Stock Exchange, while Sensex is calculated on 30, and Sensex is generally traded in the Bombay Stock Exchange. Okay, so now we'll be moving on to initial public offering. And over the last year in India itself, there have been so many new companies which have been, enlisting in the stock market and have been having IPOs. But and like generally these days, there's like a sort of hype about it, and like we want to explain to you what exactly an initial public offering is. So to do that, let's start off with a game.
Okay, so this is called Identify the Logos. We'll be putting a logo in front of you and request you to please identify this logo. You can put it in the chat box and let's see who's the fastest to identify this logo. Okay, so the first one. That's correct, Mr. Charan Singh. This is Paytm indeed. And with that, we go to the next one. What about this? That is right. This is Zomato. And what about the last one for today? That is correct. This is Nikon. Now, what is the commonality between all three logos? Their IPOs were released in last year. Now, this term we've been hearing it so frequently that IPOs are on the rise right now. So let's just see what IPOs actually are. An initial public offering or an IPO is when a private company becomes public by listing its shares on a stock exchange. What are the advantages to a company which lists itself on the stock exchange? Number one, is raising cash to increase the company's value. So obviously, if you get investors from the public invest in you, the value of your company would increase, the trust in your company would increase, and also you would gain a lot more capital, which you can use again to fund your research and development ventures, your drug diversification ventures, etc. Then another advantage is building brand image. So how does that work? Now, because there would be a lot of news circulating about IPO is releasing and IPO is coming out, etc. So people would go and search about okay, what is Nika, what is Zomato, what is Paytm, and this helps in giving them market visibility and also helps them build a brand image if a lot of people subscribe to their shares and a lot of people are believing in them. When people subscribe to the share, it shows to some extent that the public believes that in the company, that the company will be profitable. Then again, another advantage to the company is the company will have access to a lot more capital, which will be able to use in a lot more things. And lastly, there is an employee prestige and retention attached to releasing an IPO. So usually, when you release an IPO, even your employee belief in that company increases, and statistics have proven that the employee will stay a bit longer in the company, will work for longer in the company if an IPO has been released. But with advantage come disadvantage towards the company as well. First, being expensive and time consuming because the company will have to follow all the government guidelines, SEBI regulations. The government will have to hire investment banks, etc., and which can be very expensive and time consuming to a young company which may not be having that much capital. Second, it increases the regulatory monitoring of the firm and adds a lot of transparency. So, from the general public point of view, although this may be an advantage, but from the company point of view, it means that they may have to release more documents into the public, maybe release some of their how the company is doing, how the company is planning on doing, which they would have kept confidential had it not been for the IPO. Again, disclosure of financial and business information and disclosure to even the competitors in the market of that financial and business information. And this may be a small disadvantage to the company. So before that, an IPO, the company has a few shareholders, which would include the founders, or they may do a friend and family route, and friend and family may invest, etc. So they have smaller number of investors. But during an IPO, the company opens its shares to sale for sale to the public, in which anyone can become a shareholder as long as you trade in the stock market, and that means that you'll have more investors, you'll have more people investing in you because it becomes a public company. All right, so with that, we'll move on to how does an IPO work? So, what does a company do to release an IPO in the market? Number one, the company hires an investment bank which acts as a middleman between the companies and the public. So, like you have banks like PNB, you have banks like FDI, etc., for the general public, for us to be able to invest in the stock market, for to handle our accounts, to handle our finances. Similarly, a company's bank is usually known as an investment bank. Some of these underwriters are Goldman Sachs, Morgan Stanley, JP Morgan, and in Indian context, you have your ICICI, you have the Axis Bank. Now, what these do is they basically handle the company's finances, their accounts. They tell you, and they also do give some sort of advice on when you should release an IPO, how much of an IPO you should be releasing at. They take care of handling the regulate. They may take care of handling, some of the paperwork to release an IPO, etc. So the investment bank starts assembling a registration statement filed with the US SEC, Securities and Exchange Commission, or the SEBI in the Indian context, which ensures it meets all the criteria. And once all the required processes are completed, a company will be listed on the stock exchange and its shares will be available for purchase and sale. So the investment bank, what it does is when you get the money, when the people apply for your shares and the company starts getting the money from the general public, the investment bank has an account of your company which takes care of these finances which are coming in, which are going out, etc. This takes care of how much dividend you're giving to the public, etc. So that is how an IPO, in very simplified terms, works. Now let's understand some IPO related jargon. So we may have read about these in the newspapers, we may have seen them on the news, etc. Number one, and as hard and long as they may sound, they're actually pretty simplified. So let's discuss them. Number one, we have undersubscription. So let's take a scenario when a company wishes to offer 1 lakh shares, but only gets 90,000 shares subscribed. And this is known as undersubscription of shares. So from your full amount, you're getting a lesser amount of shares subscribed. That is what is undersubscription. And oversubscription is just the opposite. If a company again wishes to offer 1 lakh shares but gets 1 lakh 20,000 shares subscribed, this is oversubscription because they're getting more people to apply for their shares. They'll be getting more capital. Now, a lot of regulations do go into play when there is undersubscription and oversubscription, but we'll not get into that. We'll move on to what a price band is. Now, what a price band is this is a price range between which a stock can be getting listed. So if the price band is between 100 rupees and 130 rupees, the issue can be listed within this range. Now, let's say the issue is listed at 125 rupees, then 125 is the cutoff price of the stock. And what a fixed price IPO is that sometimes the company fixes the price of an IPO. So it doesn't have a band. So rather than having 100 to 130 band, they'll just say that our IPO will be released at rupees 125 per share. This is known as a fixed price IPO. So these were some IPO related jargons which may seem very complicated, which may seem very difficult, but right now we've just seen how simple they are and destigmatize that they can be very hard to understand, etc. And that is all for the IPOs that we've discussed. Now we'll be moving on to the things to keep in mind while investing in stocks.
Okay, so now that you all have a general foundation of what the stock market is and how to invest, what the different types of stocks are, like there's an IPO, you need to know some things to keep in mind while actually doing the part of investing. So the first one, which is the most important, is to do good research about the stock market itself. And I feel like by attending the session itself, you're educating yourself on the stock market, and this is very important. It's very important to know the stock market well before you actually start investing and make advice decisions. The second one is to research well about the different parameters and understand your investment goal. Then there's a point, which is that herd mentality is not always the right mentality. So maybe the general public is saying that a stock is good or a stock is increasing. However, that's not always the case. And if you just blindly follow herd mentality, it could lead you to having potential losses. And it's very important to do your own evaluation and evaluate how the stock market is doing yourself before you just support someone else who is telling you to invest. The third one is that you should evaluate how much risk you are willing to take. If you have a lot of money at hand and if you feel like you can easily invest that money and you're not really worried about losing it, then that means that you have a high risk potential and you can take more risk. But if you feel like that money you have is not enough and you want to keep that with yourself, you don't want to take such a big risk, you should invest in stocks, or you should invest in things that are safer. uh, the third one is that you should not take loans to invest in the stock market, because what happens is that there's always that element of uncertainty while investing, and you never know that you're never 100% sure that you're going to get returns on something that you invest. You're not sure whether you incur losses. So if you do incur a loss and if you take a loan to take that money to invest in the stock, you may not be able to pay back that loan, and that can put a lot of financial pressure on you. And the last point to keep in mind is that you should diversify your stocks, which means you should invest in different things so that you don't put all your eggs in the same basket. But you should not over diversify, because that can also lead to a lot of complications and problems. So that brings us to stock market simulations. And a lot of you might not be 18 yet, or you might not have that steady source of income to actually invest in the stock market. Or maybe you just want to try out how it works before going into the real thing. So here are a few stock market simulations that you could try out yourself, and to get an idea of the market before you actually start investing in the real stock market. Okay. And that brings us to the end of our session today. So if you have any questions, feel free to post it in the chat and we'll take them. Okay, so we have a question. It's, what does subscription of an IPO mean?
All right. So subscription of an IPO basically means that when you're when the company issues the IPO into the market and the public essentially pays the first amount of money, which is the application money, to say that they're interested in the stock. That is what subscription is. So when you, as an investor or the general public, pays the first pays a some amount of money to say that they're interested in the shares, or they want to buy these shares, or they want to have these shares, that is called subscription of an IPO. Dhruva, does that answer your question? Also, Dia, there's a request to go back to the previous screen.
Yes, I'll just do that. Yeah, you guys can take a screenshot if you want so that you have these with you.
All right, so are there any other questions? If not, then it'd also be great if you could put in maybe one thing that you've learned from this session, and one thing that one new thing that you've learned from this session, or one thing that you can put to use from this session. That'd be great too. So, Akshat, a cryptocurrency is basically a digital currency which is based on blockchain. So its market is also different. Stocks are based on a few companies, and when companies list their stocks, whereas crypto is based on blockchain, and it's sort of a digital currency which people invest their money into. And crypto is actually a very complicated concept, and we would, if you all would like, we would love to have a session again on crypto and sort of explain what cryptocurrency is, etc.
Yeah,
Now,
we will be publishing the recording on the group so you all can see it once it's done. Yeah.
all right, so what is a bear market? A bear market is basically when the market has seen about a 20% drop in prices. So when the indices fall, or a company share is falling, or the whole market is falling as a whole, that is referred to as a bear market. But do note that a bear market, for it to be called a bear market or a bearish market, you need to the trend must be able you must be able to see the trend over, let's say, a few months. So it can't be just a day or 2 days. So does that answer the question on bull and bear markets? The recording will be put on the link for the recording will be put on the WhatsApp group. So request you all not to leave the WhatsApp group. um,
Okay, so I think that brings us to an end to the end of our session, and we would like to thank you a lot for attending this session, and we really hope that you learned and you enjoyed the session. So if you have any questions, ideas, or thoughts, we're open to feedback. We're open to your ideas, and if you want to learn anything, let us know because we can have many sessions like this in the future. And don't please don't leave the WhatsApp group, as we will be sending updates about upcoming programs, and we'll be sending general financial literacy updates. And do make sure to follow us on Instagram and check out our websites for more details about what we do. So once again, we would like to thank you all a lot for attending the session.
okay, Manak, you had the question, what age can kids invest and open a demat account? Now,